Hello guys. So in this session what I'm going to do is I'm going to explain only that hedge effectiveness, that is basically cash flow hedge, and we'll discuss the entire question again. So before discussing this entire question, first I would like to set out a few points here. The points are basically just a quick recap of how cash flow hedge works. So first of all, you have a future commitment, or you have a highly probable future cash transaction and you want to hedge it. Basically, like you promised somebody that you are going to purchase an asset from them, or you are going to purchase some inventory from them. So that's a what do you call it, firm commitment. You promised somebody that you are going to do that. Or in another case, you have a situation where you know you are going to buy an asset in the future from a foreign country, or maybe in the home country as well. So this is a highly probable transaction. You don't have any contractual obligation, but still you might have a highly probable future transaction, right? So in either of these cases, we can enter into forward contracts or future contracts or options or anything. So first of all, you need to understand that in a cash flow hedge, the organization has to first, at the inception of that particular contract, when the contract is being signed upon, when the forward contract is agreed upon, the organization has to first designate that particular instrument as hedge accounting. We have already discussed that at the initial stage itself. Hedge accounting is not mandatory. Hedge accounting is optional for the organization. So if the company has designated that instrument as a hedging instrument and it is designated as a fair value hedge or a cash flow hedge, depending upon which type of item you are hedging, then accordingly our accounting treatment shall vary. Now, so fair value hedges are basically where you want to hedge an item's value changes. Like you already have some inventory, you are worried about its value fluctuations, or you have certain asset and you are worried that the price will drop in the future, right? You are basically hedging for the value changes of that item. On another hand, cash flow hedges are where you have receivables or payables and you want to hedge that particular value changes, right? Now, IFRS 9 specifically talks about one particular item which can be categorized either as a fair value hedge or as a cash flow hedge. That is basically forward contracts in foreign currency. Not just forward contracts, any contracts, any derivative instruments in foreign currency, they can be either classified as a fair value hedge or a cash flow hedge. Sir, why? Let's say for an example, I want to purchase an asset from a foreign country. Let's say I'm an Indian organization, Indian company. I want to purchase an asset from a US based company and I want to pay it in dollars. Obviously, I have to pay it in dollars if they are invoicing in their home currency. Now, the issue is that I'm saying that I will purchase this particular asset after 6 months maybe. So in this 6 months, there are two types of changes that can happen in this particular contract. One is the asset value itself can change, and the other one is the dollar to rupee exchange rate can change, right? So we are having an exposure to both fair value changes and currency changes. So IFRS 9 says that when you are having a foreign exchange derivative instrument, you can either designate it as a fair value hedge or you can designate it as a cash flow hedge. So what difference does it make? If you recall carefully, if it is a fair value hedge, both hedged item and the hedging instrument, shall be classified as fair value through P&L, even though the underlying hedged item is previously a financial debt security which is classified as fair value through OCI. We have already discussed that. Even if the debt security was classified as fair value through OCI and now you are entering into a hedging contract against that particular item, then both hedging item and the hedging instrument will be classified as fair value through P&L. That is what we have already discussed. And when it comes to the cash flow hedge, we have discussed that the effective portion of the cash flow hedge shall be recognized in the other comprehensive income. The effective portion of the cash flow hedge shall be recognized in the other comprehensive income, OCI. From OCI, it will go to OCE, other components of equity. Other components of equity that is a side heading. So within that, you have one separate side heading that is basically cash flow hedge reserve, right? So any changes in the cash flow hedge, any changes in the cash flow hedge shall be recognized in the other comprehensive income and shall be accumulated in a cash flow hedge reserve, right? And the ineffective portion of the cash flow hedge shall be immediately taken to the profit and loss account. This is what we have already discussed, right? Chalo. Also, just a quick recap again. If the fair value changes in the hedged item, again repeating, if the fair value changes in the hedged item is more than the fair value changes in the cash flow hedge instrument, fair value changes of hedge item is more than fair value change in hedging instrument, then it is an effective transaction, no problem. But if the fair value change in the hedging instrument is more than the fair value change of the hedged item, then that excess portion shall be called as the ineffective portion. We have discussed a question where the underlying item is changed by maybe 10,000 and the cash flow hedge instrument has increased by 12,000. So hedged item has a delta change, that is delta of change of 10,000. Cash flow hedge reserve, cash flow hedge instrument has a fair value of 12,000. That excess 2,000 is the ineffective portion which will be immediately transferred to P&L. This is what we have discussed, right? If you remember. Now, very quickly, let's go to our question and solve this particular thing. This is a very comprehensive question which should give you an overall picture about how cash flow hedges work, right? Let's see. Is it transferred to the regular screen? Okay. So, pardon me for that. Now, on 1st November 2020, a company in United States has agreed to purchase an equipment from Europe, which is in euros, in 6 months' time at an agreed price of 50 million euros. Okay. The company has entered into a forward contract for the same at $1 equal to 1.6 euros in 6 months' time. Absolutely fine. The spot rate and the forward rates expiring on 30th April 2021 are given as follows. Okay. So 30th April, 1st November, December, Jan, Feb, March, April. So 6 months. Absolutely fine. So today, right now, the spot rate is $1 equal to 1.55 euros. And at this date, you have agreed into a forward contract for purchasing $1 for 1.6 euros or for exchanging $1 with 1.6 euros. And at the reporting date, that is the 31st December 2020, when you are preparing your financial statements, your balance sheet and your statement of financial position, whatever you want to call it. So $1 is exchangeable into 1.3 euros in the spot rate, and on that date the forward rate for April is $1 is equal to 1.34 euros, and as on the actual date of settlement 30th April, $1 is 1.1 euros, and forward rate also will be the same because these are forward rates for 30th April, right? Those are the forward rates for 30th April 2020, obviously. So for spot rate and future rate, forward rate will be the same for the same date. Now, just before we even start solving this particular situation and identifying all the delta changes and blah blah blah, first let me ask you a very straightforward, simple question. If all the accounting is kept aside, if I am talking from a financial management perspective, okay, keeping aside all my accounting treatments from a financial management perspective, if you think carefully what is happening here, I entered into a forward contract with my banker saying that $1 can be converted into 1.6 euros after 6 months. Absolutely fine. I have to pay 50 million, right? I have to pay 50 million. So the settlement value, settlement with the banker shall be basically, I'll give him some amount of dollars which is depending upon this exchange rate, and he will give me 50 million euros, right? That is what the forward rate is entered upon. That is how the forward is entered into, right? So how many dollars should I give him? He'll give me 50 million euros. So how many dollars am I supposed to give him? So 15 million euros divided by 1.6, because that is our forward rate, right? So 1.6. That means I'm going to pay him 31,250,000. So I'll pay him $31,250,000 and he will give me 50 million euros. Those 50 million euros I'll directly transfer to my supplier and I'll get the machine. And what is the spot rate on that date? Spot rate on settlement date is $1 equal to 1.11 euros. If I had not entered into this particular contract of forward, so how many dollars am I supposed to pay? $50 million divided by 1.1, which is 45,454,545 dollars. So if I had not entered into this forward agreement, I would have been expected to pay 45.45 million, whereas I am paying only 31.25 million, right? So it means that this particular derivative instrument, the forward contract, is going to save me, or profit from this forward contract is how much? $14,204,545. So by entering into this particular forward contract, I am saving myself 14.204 million. Okay, so that's why, my dear friends, see, you can see that the difference is only what? $1, 1.6 and 1.1, so 0.5 difference into 50 million euros. It makes it $14 million of difference. So please be very careful with the decimals as well, right? Okay. Now this is just a comprehensive scenario for us. Okay. Now we got an overview. We know how much savings are there from the forward contract. Now let's see how to deal with the transactions. So first of all, on 1st November 2020, there are two items that are being dealt with here. What are the two items? One is we have firm commitment to purchase the asset. Right? First of all, we have a firm commitment to buy the asset, and the second one is we entered into a forward contract. And in both these cases, whether it is a firm commitment or whether it is a forward contract, there is no entry for both of these because forwards do not have any initial outflows. Right? Next one. On 31st December 2020, here comes the problem for me. So first of all the cash flow, all the derivative instruments has to be valued for fair value as on the reporting date. If it is a hedging item, then hedge accounting shall be followed. If it is for fair value, then we'll classify it as fair value through P&L. If it is cash flow, we'll take the fair value changes to OCI. This much we already know, but we need to first identify whether it is an effective hedge or is there any ineffective portion as well, right? So how do I identify that? See, in this particular scenario, how do we identify fair value changes in the underlying asset? Very simple. Exclude your forward rates because that is for the hedge instrument, right? So this is hedging instrument. Hedging instrument, that is the forward rates that we are dealing with. And this is the spot rates which deal with the hedged item. Okay, and we know that if the fair value movement in the hedging instrument is more than the fair value movement of the hedged item, then there is some ineffective portion. So let's see how it is dealt with. Okay. Now, first of all, I'll just leave some. Okay, first I'll directly write it here. So on 31st December 2020, delta, that is change in firm commitment. What is firm commitment, ma? That is your underlying item or that is your hedged item, right? Firm commitment is hedged item for us. So how much change is there? 50 million euros. When we entered on 1st November, the spot rate is 1.55 and on the reporting date it is 1.3, right? 50 million and $1 equal to euros 1.55 and $1 equal to euro, how much? 1.3. Okay. So technically, if I want 50 million euros on the date of inception of that particular contract, how many dollars do I need? 50 million divided by 1.55, which gives me 32,258,045 dollars now, right? And on the reporting date, I need 50 million divided by 1.3, which is equal to $38,461,538. So what is the delta here? Minus 32,25,8045. That is exactly $620,000. Sorry, 6,203,493 dollars. 6.2 million, right? Roughly 6.2 million I can consider, if I'm rounding it off to the nearest millions. 6.2 million it will be. Okay. Now similarly, what I need to calculate? Delta in, that is change in forward. This is for hedging instrument, right? So for 50 million euros, the forward rate that we entered into was 1.6 and the reporting date it is 1.34. So $1 is equal to euro 1.6 and $1 is equal to euro 1.34, right? 34? Yeah, 1.34. So how much change is the delta? So 50 million divided by 1.6, that is, this value shall be $31,250,000 and this value shall be 50 million divided by 1.34, which is equal to $37,313,433. That means there is a change of 31 to 50 000, that is $606,433. See, the change in the hedging item, the change in the hedged item is more than the change in the hedging instrument. So this is completely effective portion, right? Delta of hedged item is greater than delta of hedging instrument. Hedging instrument. So this implies entire portion is effective. And what is the treatment for effective portion? It will be treated in other comprehensive income. So debit forward contract, how much? 6.06 million, 6063,433. Credit OCI, in the profit and loss it will be recognized in the other comprehensive income, and from there it will be transferred to cash flow hedge reserve, which will be held in OCE, other components of equity. So $6,063,433, right? This is as on 31st December 2020. Now moving forward, next one, as on 30th April 2020. So this has to be 2019, I'm so sorry. Or let's make this 2021 now. This will be easier for us. Okay. 30th April 2021. This shall be 2021. Okay. So 30th April 2021, it is $1 equal to 1.1 euros. Okay. So first of all, delta in hedged item. So previously, what was the rate that we evaluated? We valued it at 1.3 euro 1.3, and today it is $1 equal to euro 1.1. So this value we already know from above calculation. It is 38,461, 538. 31,468. Sorry, 461, right? 38,461, 538. 38,461, 538. Yeah. Okay. And then this value $1 equal to euro 1.1 for 50 million. 50 million euros divided by 1.1, that shall be giving you 45,454,545 euros. Sorry, dollars, right? So the difference is 38,461, 538 minus 454545. That is $699,307. 6,993,007. James Bond 007. Okay. Next one, delta hedging instrument. Why did you change? Hedging instrument. So the previous value was how much? Forward rate. Previous forward rate was 1.34, right? So $1 is equal to euro 1.34, and today $1 is equal to euro 1.1, and this value we already know, 454,545. Fancy number. And this value we already know from above, that is 37,313,433. 313,433. So this change is how much? 37,313,433 minus 45454545. This is $8,141,112. Okay, here comes a problem. If you think carefully, there is a slight issue here, because delta in hedging instrument is greater than delta of hedged item. So there is some ineffective portion. So ineffective portion is equal to how much? Ineffective portion is 8,141,112 minus 6,993,007. So that gives me the ineffective portion to be 8,141,112 minus 6,993,007. That is $1,148,105. This will be immediately taken to the profit and loss. So what shall be the entry here? Debit forward contract. The total gain 8,141,112. 8,141,112. This is the total derivative value, forward rate. Credit other comprehensive income, and from there it will go to cash flow hedge reserve. How much? The effective portion 6,993,007, and credit profit and loss. This is the ineffective portion, $1,148,105. Right? I hope you guys understood it. Now very quickly let's check the balances in derivative first of all. So forward contract value is how much? Total value of forward contract in our books of accounts. Here debited 6063,433. 6063,433 plus here 8,141,112. 8,141,112. Sum it up. 6063,433 plus 8,141,112. That is $14,204,545. So doesn't it look like we have seen this figure somewhere? Let's go back to the first comprehensive part that we did. 14,204,545. 14,204,545, the value of the entire forward contract change. So that is not a rocket science or something. I just split this 14 million into 2 years, that's all, into the two separate dates, that's all. So obviously the total should tally. And what is the balance in cash flow hedge reserve? Cash flow hedge reserve. There is some balance in the cash flow hedge reserve now. So here we have 6063,433. 6063,433, and here also the effective portion 6,993,007. 6,993,007. So the total balance in cash flow hedge reserve shall be 6063,433 plus 6,993,007. That is $13,056,440. Now, on the settlement date, what actually happens is, okay, so there are two ways to say this. First, you will go to your banker, you will pay him whatever dollars it will take as per your forward rate. So your forward rate agreed was 1.6. So you will pay your banker $31,250,000 and he will give you 50 million euros. So this euros you will settle with your your supplier, right? Actually what happens is your banker will pay you the difference. He will pay you this 14,204,545 mark. Okay, he will tell you that go and pay your supplier 45 million. I will give you the loss of 14 million. Whatever loss I am having, I will give you that 14 million. Okay, that is how usually the transaction works. So on the settlement date, the transaction shall be debit property, plant and equipment. We are going to purchase a property, plant and equipment, and debit cash flow hedge reserve. Whatever cash flow hedge reserve I am having, I need to settle that off. Then credit bank, because I need to make the payment. Credit, anything else is left? Derivative instrument, that is the forward, because it is now being settled. So forward contract will be settled off. So what is the transaction values? Okay, forward contract has a value of $14,204,545. So banker, how much will I pay to my banker? We have already calculated that. I'm going with the first option, 31,250, right? $31,250,000. Cash flow hedge reserve is $13,056,440, and the property, plant and equipment shall be the balancing figure. So how much it is? I'll tell you how property, plant and equipment value also come. Don't just think that it is balancing figure. 14,204,545 plus 31,250,000. So that is 45,454,545 minus 130,56,440. So this shall be equal to, property, plant and equipment is equal to $32,398,105, right? Okay. If you recall, in the previous video at the ending, I must have told you about how to discuss about the settlement transactions. So if the cash flow hedged item ultimately results in a non-financial asset or liability, the cash flow hedge reserve will be adjusted with the initial recognized value. If it gives rise to any other, basically like financial instruments, then whatever cash flow hedge reserve is accumulated, that will be recycled to the profit and loss. You must have remembered that because it is right at the end of the previous session. So just repeating again, cash flow hedge reserve, if it is giving rise to a non-financial item, non-financial asset or liability, so it shall be adjusted with initial value. Adjusted with initial value. And if it is any other item, basically any financial assets or liabilities, then recycle to profit and loss. This is what we have discussed, right? So if you see here, whatever cash flow hedge reserve is there, that should be adjusted with the initial value of the property, plant and equipment. So let's see property, plant and equipment. Property, plant and equipment. This value shall be 50 million euros, obviously. So let's convert that into dollars using the spot rate at the settlement date. Now, forwards has nothing to do with actual purchase from your supplier, because your supplier will demand only the spot rate from you. He will demand 1.1 from you. He will demand 45, 454, 545. Okay. At spot, that is $1 equal to euro 1.1. So that is equal to dollar 45,454,545 dollars, right? Okay, minus what is the cash flow hedge reserve that we are having? 13,056,440. 13,056,440. Check the total. 45, 45, 45, 45 minus 13,056,440, which is equal to your 32,398,105 dollars, which is exactly equal to this balancing figure, 32,398,105. This is not just a balancing figure. Your books might say it's a balancing figure, but this is nothing but spot rate minus cash flow hedge reserve. Okay, value of the underlying asset, value of the hedged item using the spot rate minus the cash flow hedge reserve that you have accumulated over the period, right? So that, my dear friends, gives you a comprehensive example of how to deal with cash flow hedge accounting for forwards, right? The same accounting treatment shall apply by futures options as well. Instead of here having the forward rate, I'll have the fair value of the future or fair value of the option. That's the only difference. Rest everything shall remain the same, right? Chalo. And in case of a future or an option, initially we must purchase that future or an option by paying some amount. So we'll have first initial value, debit forward, debit derivative instrument, credit bank. That entry also will come. That's all. Rest everything will remain the same. I hope you guys understood the entire concept here. Thank you guys.